Alright guys, it's time for part 2 of the worst performing stocks of 2018 that are listed on the S&P 500. Let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. Now I don't want to waste any time. If you missed part 1, make sure you check out the pinned comment down below. It'll have a link to part 1. You can go watch that and then come back here. On that one we covered stocks 10 to number 6, and today we're going to talk about stocks 5 to number 1. So let's go ahead and get started. Alright guys, kicking things off here with stock number 5, we've got Perrigo Company, ticker symbol PRGO, and they're down over 55% in 2018 alone, and they're down an astonishing almost 75% in the past 5 years. Man, I really feel bad for anyone that invested in them, but they used to trade at over $190 per share and have now fallen to just $38 per share, which is pretty bad. Now, as far as the company goes, this is actually a healthcare and pharmaceutical company that operates worldwide, including the US, Canada, Mexico, the UK, Australia, and Israel. And from what I've read, the majority of their business seems to be focused primarily around developing and selling consumer goods, including pharmaceutical over-the-counter drugs. They also have a pretty high individual stakeholders count of over 12%, which makes me feel really bad for any individual shareholders that have been absolutely burned by the price performance over the last 5 years. Now, much of this has to do with some really bad business performance, with 2016 in particular being a horrible year where the stock dropped by over 40% when the company was reporting net income for the year at negative $4 billion versus other years where they were actually profitable. And the pain has continued up to this latest quarter where sales are down year over year by over 6% and net income was negative versus the year prior, which was positive. On top of that, Perrigo acquired Elan Pharma, I might be pronouncing that wrong, but Elan Pharma back in 2013, and the Irish government is now accusing Elan Pharma of only paying a 12.5% tax rate on the sale of a sclerosis drug called Tysabri, probably pronouncing that wrong too, which it sold to Biogen, and that tax rate should have reportedly been much higher at 33%, which is close to 3 times the amount. Of course, Perrigo is planning to fight the accusation and have stated that they strongly disagree with the assessment, but if this ends up being true, Perrigo may have to pay $1.87 billion in back taxes, which is very significant considering that their current market cap is only around $5.3 billion according to Yahoo Finance. Speaking of which, their valuation still shows a very high trailing PE of about 44, but their forward PE does improve dramatically to under 9 with a PEG ratio of 1.7, PS ratio of 1.1, and PB ratio just under 1. Still, this doesn't really seem like a cheap enough stock for someone like me who doesn't really like to invest in pharmaceutical stocks. It's not really an industry that I mess around with too much, but if that's an industry that you're looking into, well, you know, this stock used to trade at around 5 times higher, so this was definitely a stock that used to trade much higher. There could potentially be some upside here, and especially with all of this negativity going on with that whole deal with the Elan Pharma and the tax rate and that potential fine. So there's still some uncertainty in the short term, but you know, if that ends up getting resolved, maybe there's some potential upside there. But in any case, this isn't really a stock that I'm interested in. Pretty bad price performance in the past, probably some fundamental issues with the company. I'm just not very interested. Okay guys, now moving on to stock number 4, we've got General Electric. Now this is one of the stocks that I hear people talk about the most. This stock has really been beaten down, and a lot of people ask me to give my opinion on the stock all the time and to give an update video, but don't worry, an update video is coming later on. But as of 2018, this stock has dropped by over 56%, so over half of its value completely wiped clean in a single year. And in the past 5 years, the story gets even worse, with them dropping by over 72%. So anybody that has held on to this stock in the past 5 years is likely not feeling too good, especially when you consider the fact that they took away their dividends too. So now you're not even being rewarded for hanging on, and they currently trade for less than $8 per share. And when looking at their valuation, based on future estimates, they have a forward PE of less than 10, a PS ratio of just 0.57, which is pretty low, but their PB ratio is a little higher at over 2.2. Now, as far as the company goes, this is a company that revolved around segments like power, oil and gas, aviation, healthcare, transportation, appliances, lighting, and GE Capital. I can't get into too much more detail because it would take up the entire video, but the reason for the stock performing so poorly is really because the company was just horribly mismanaged, and for a company the size of GE to really tank as much as it has, it doesn't just take a few mistakes, but an entire history of poor decision making. A lot of this blame was being placed on their old CEO, Jeff Immelt, who was in control from 2000 until he retired in 2017, and many would argue that under his leadership, GE was relying too heavily on their GE Capital segment, which was crushed during the 2008 financial crisis, but GE later rebounded with investments in oil and gas, only to struggle once again when oil prices dropped. On top of that, GE really made some horrible acquisitions at horrible prices, sold assets at horrible prices, and even bought back some of their own stock, again at horrible prices. And all of this negativity was really elevated by the fact that a lot of their segments were really underperforming. Just the year prior in 2017, power made up the biggest portion of revenue, but also accounted for the biggest drop in revenue and the second biggest drop in profit year over year, behind their GE Capital segment, which lost almost $7 billion. And while aviation and healthcare have performed well for them, they weren't big enough segments to lift the company up, which was being dragged down by their other segments that continued to struggle. Now, ultimately, this led to a lot of hope being placed on their new CEO, which was John Flannery, who was famous for turning their GE healthcare segment into a success story, and under his leadership, they cut their large dividends by 50% and continue to either sell or spin off parts of their business, but he's already been let go from the CEO position in October of 2018, so just about a year after taking the role. Now, they do have a new CEO by the name of Larry Culp, who under his watch, GE is now cutting their dividend even lower, down all the way to 1 cent, which is basically nothing. I mean, they're just kind of keeping it around so that they can say that they're paying a dividend for many years, which is kind of a shady thing to do. But in any case, they're basically cutting that dividend by the end of the year, which is definitely going to hurt any dividend investors who were interested in GE or were already invested. But this move does save the company about $4 billion of cash per year. And the other thing about the new CEO that I find very interesting is that his compensation is heavily tied to the stock's performance. Because if the stock climbs by 50% by the end of the third quarter in 2022, then Culp gets 2.5 million shares worth around $47 million. And if the stock climbs 150%, then that climbs to around $233 million, combined with his annual pay and rewards that could add up to over $300 million. I mean, talk about a massive payday there. Still, this is a company that will take more than just motivation to turn around, considering that in their latest quarter, revenue was down again by 4% year over year, and adjusted EPS was also down 33% year over year, both figures missing analyst estimates. I know that they have some plans to reorganize the company, including a new cost structure for their power segment that saw another massive drop in revenue by over 30% year over year, but I just think it's going to take a while until they can really start to turn things around, and I'd like to see them actually perform a little bit better before I even consider investing in GE. You know, I made a video on GE stock back in 2018, about like halfway through the year, and the stock was trading at around $12 per share. I think it was like over $12 per share, and now it's trading much lower than that. So I'm kind of happy that I never jumped into the stock, and I basically said the same thing then that I'm saying now, which was that I didn't want to jump in until I actually saw them perform better. And so it ended up being a good move because the stock kept going down. But I have to admit, at this valuation, with the stock being beaten down as much as it is, I am becoming more interested in GE. I am tracking it a little bit closer, and I do think that there is a lot of potential upside there, but I'm still just kind of waiting on the sidelines to see if they can actually start to turn things around, and I'd like to see them actually perform a little bit better before I consider investing. Okay guys, now coming in at number 3, we've got Elle Brands, and this is another interesting one because I also made a video about Elle Brands stock about 6 months ago, and the stock was then trading at around $36 per share, and I made a very bearish argument on the stock, and I said that I just didn't really believe in them. But since then, the stock has dropped even more, and it's now down to just around $25 per share, and it's down over 57% in 2018 alone, and still down over 55% in the past 5 years. Now, when looking at their valuations, their trailing and forward PEs look about the same at 9.6, and their PEG ratio is a bit high at 3.8. In terms of the business, Elle Brands is mostly a retail company that owns huge brands like Victoria's Secret, Bath & Body Works, and Pink. Now, the reason I didn't believe in them in the first place is because it's a company that hasn't really performed well for years. I remember bringing up the fact that their margins had been decreasing for years, either because of higher spending on marketing or because of lowering prices. Either way, that means that competition was intensifying, and this is in a world where malls are struggling and e-commerce like Amazon is thriving. So I just struggle to see the long-term bull thesis on a company like this. Having said that, their online sales are helping offset some of the declining sales of Victoria's Secret, which makes up the majority of their revenue. Including online sales, Victoria's Secret comp sales only decreased by 2% this latest quarter year over year. But if you take online sales out of that, then comp sales for Victoria's Secret actually decreased by 6% year over year. Still, Bath & Body Works seems to be performing very well, having jumped by double digits year over year and helped drive total revenue higher by over 5%, and they even beat estimates on EPS and revenue. However, all eyes seem to be on their huge dividend, which currently sits at over 9%, which is just absolutely massive, with a payout ratio of almost 90%. But management warned that they will be cutting that dividend in half in 2019, which led to the stock selling off despite posting revenue growth. In any case, this isn't really a stock that I'm interested in. I just don't really believe in their business. Although even if you cut that dividend in half, it's still going to be pretty darn large. So I could see some investors being interested in this stock, maybe as a value play and even as a dividend stock. But for me personally, I just don't really believe in them, so it wouldn't really make sense for me to invest in them. Alright guys, coming in at stock number 2, we've got Mohawk Industries, ticker symbol MHK. And this is a company that I've never really heard of myself, but apparently they're a flooring company that designs, manufactures, and sells both residential and commercial flooring products, including carpet, rugs, ceramic, porcelain, natural stone, hardwood, laminate, vinyl, insulation boards, and several other types of products. Now, when looking at their stock, they're down massively in 2018 by over 57%, but this is one of the few stocks that actually has much better 5-year performance, being only down by 21%, and that has to do with them having a very large rally before finally crashing in 2018. And the reason why is really because of disappointing earnings throughout the year. In fact, the stock dropped by over 17% on their Q2 earnings release and by over 23% on their latest Q3 earnings release, missing analyst estimates in both, and the CEO stated that sales in all segments were lower than expected. And even though revenue increased by 4% year over year, adjusted EPS still dropped by over 12% year over year, and even year to date, it still dropped by about 4% year over year. In any case, they now have a really low trailing PE of about 2, but their forward PE is much worse at over 10, so estimates must be looking pretty bad for next year. And they currently do not pay any dividends either. So there's not really much else to say here. I have no clue about the flooring industry. I don't know anything about that kind of market. It's definitely not a company that I would invest in unless I did a lot more research. But, it's just kind of a shame that they had a very nice rally up until 2018 and then everything just kind of came crashing down. But, that's just kind of how it goes sometimes. Either way, not really a stock that I track or that I'm interested in investing. Okay, guys, last but not least, we've got one of the biggest beauty and fragrance companies out there in Coty. I'm not sure if I'm pronouncing that right, but ticker symbol is COTY. And they are down an enormous 67% in 2018 alone. And again, just like the last one, this is a stock that had a pretty nice rally at the start of their most recent 5 years, but has since crashed, ending down about 57% in the past 5 years, and currently trade for just about $6.50 per share. Now, as far as the business goes, this is a large beauty products company, and they claim to be the world leader in fragrances with the number 2 position in salon hair and number 3 in color cosmetics. Now, they either own or have a major partnership with huge brands like CoverGirl, Burberry, Calvin Klein, Gucci, Adidas, Chloe, Boss, Marc Jacobs, and the list goes on. Now, as far as why the stock has been performing so poorly, much of that has to do with weaker performance in their business, which is a result of cosmetic stores and department stores closing, which really hurts the sales of beauty products, but also because new kids on the block like Ulta Beauty, Sephora, and MAC have gained enormous popularity, and that increase in competition has had a negative impact on Coty. Now, they also acquired Procter & Gamble's beauty business back in 2016 for around $12 billion. And they saw some periods of struggling, they saw some periods of actual growth thanks to that, but lately Coty has been struggling to find the synergy that they once hoped for. And when looking at their latest quarter, they saw revenue drop by almost 10%, and they also named a new CEO, although they claim that the old CEO stepped down due to family reasons, but we don't know if any of that is true. In any case, the stock now has a forward PE under 10, a PEG ratio of 1.2, and some pretty low PS and PB ratios, both well under 1. And because of the low price, their dividend yield is now at a massive 7.6% yield, but it has 0 years of growth and a pretty high payout ratio of over 75%. So I have no idea if that dividend is sustainable. I don't know if it'll be cut anytime. I haven't read anything about that, but it seems like it's a very large dividend, so I do wonder if they have any plans to cut it in the future. Either way, this isn't really a stock that I'm interested in because I know very little about the cosmetics market, and I'm also worried about their supply chain because their old CEO said that supply chain disruptions have hurt their latest earnings and will likely continue in the next quarter before being resolved the quarter after that. So I could see some volatility continuing, at least in the short term. Alright guys, I think that just about wraps it up. Thank you so much for watching. If you enjoyed the video, if you liked the channel, make sure you support it by hitting the like button. And let me know how you feel about any of these stocks. Are you invested, or are you thinking about investing in any of these companies? I know a lot of people are paying attention to GE right now, Elle Brands, even this last one that we talked about, Coty or Coty, I don't know how to pronounce it. But those are some pretty popular stocks as well, and they're beaten down pretty badly right now. So maybe there's some upside, maybe there isn't. Maybe they'll just continue to fall like falling knives do. But I'd love to hear your thoughts on it. So let me know in the comment section, and I will catch you guys in the next video. Take care. Bye-bye.